Thank you.
And there we are.
All right. Now we are recording. All right. Welcome to the Austin Women's Investing Group. So we are a dynamic and diverse group of women who enjoy learning and sharing investing ideas in a fun and comfortable all-female setting. So if this is your first time here, welcome. If you are a member who's been to our meetings before, welcome back. It's good to have everybody in the same virtual room together. I am Sarah Glakis, so I'm an investor and an advisor and the co-founder of the Austin Women's Investing Group, which you have found here. A friend and I, so just to give everybody a little bit of background on the group, especially if you're new here, a friend and I started Austin Women's Investing Group back in 2011 as just like a way to get a bunch of women together in a room to talk about finance and investing and money topics, because I think that, we both found that we didn't really have that in our everyday life. So that's how the Austin Women's Investing Group was born. And now it's 10 years later. We have over 2,700 members in our group, which is awesome. We're not only in Austin, now we're worldwide, thanks to being able to kind of go virtual and invite members from all over the country and all over the world. So if you know anyone who could use a group like this or who'd like to be a part of it, you don't have to live in Austin anymore, because for at least the near term, we're going to be still doing our meetings online. We also have a bunch of women in our private Facebook group. So that's another place where you can join us and kind of keep the conversation going, start conversations, drop resources for your fellow investors there. So if you haven't joined that already, please do. On the same note, if you're part of the Facebook group and haven't joined the Meetup group, please join us on Meetup, because that's where we push out the information on the meetings, upcoming meetings, and we will be sharing the slides from this meeting and the link to the YouTube channel via the email that goes out via Meetup. So it's good to be a part of both the Meetup and the Facebook group, just so you get all of the information that we're trying to push out to everybody. One of the things that and as Lori mentioned last time, and I've kind of forgotten to say this, we also have an Austin Women's Investing Group YouTube channel. So we'll be posting this video to our YouTube channel so that you can come back and revisit it. But you can subscribe to our YouTube channel and then see new videos as they get uploaded, every month or so. Just so everybody knows, again, especially for first-time members, this group really benefits from all levels of investing experience. I know that when I'm out there in the world trying to recruit people to the group, I often get like, well, I don't think the group is right for me because I don't know anything about investing. That is exactly who the group is for. If we have people who are just starting and asking all of the questions, and we have people with more experience who are there to also ask their questions, but also help give people advice and recommendations and answers to the questions that are put out there. That's how the group works. So back before we were online, we would sit together in a room at the Austin Public Library. And if you think about like sitting in a circle, a lot of our topics would be led by an expert, but then little side discussions pop up. So we're trying to recreate that here. It's supposed to be interactive, lots of questions. As questions get put into the chat box, Lori and Gwen and myself will be going through and collecting them for Annabelle and Manisha. But if you see someone's question and you have the answer to it, please drop it into the chat box. Some really, really good discussions end up happening in the chat box. So it's good to have it open, and it's just kind of another part of the experience. So please take advantage of that. Our topic today is how to use all of that equity that you might have in your home. So it's being led by Annabelle Gall and Manisha Gupta. So we are so, so grateful that they are here. And we really can't thank them enough for coming in and sharing their expertise with us. I will also let them go through and introduce themselves in their own way once we start the meeting. But we are run by volunteers. All of the people that come in here are volunteering their time to share their expertise with us. So we are always so grateful for people who come and offer to lead a topic with all of you. Before I start, and Manisha and Annabelle are both investing professionals like myself. So I think today I'm going to take a little bit of extra time and just take a moment to be very clear that nothing in this meeting is intended to be individualized investing advice. We are here as investing professionals to share our knowledge with everybody in the group. But if you need personalized advice, you should enter into a formal relationship with an advisor first. Everything here is, we believe to be factual, but it is just kind of thought leadership and opinions and knowledge that we're sharing with the group without it being investing advice. So without further ado, I will turn it over to Annabelle and Manisha.
Great. Thanks so much, Sarah. And hello, everyone. Thanks for spending your afternoon with us on such a gorgeous Austin day. I feel like we're finally over the hump for the hot winter months. And this is really why you live in Austin, for days like this. So thanks so much for joining us. And thanks to Sarah and Gwen and Lori for organizing and for helping us put this together. Manisha and I are financial planners and advisors at Austin Wealth Management, which is an independent fee-based fiduciary wealth management and financial planning firm here in Central Austin. Manisha and I are particularly passionate about issues involving financial security and women. And this is an issue that we are hearing about all the time from our clients. And we have some information to share today, but also would love it for it to be a collaborative discussion where we're, exchanging what we know, but also hearing more about your experiences and lessons learned as everyone else is sort of experiencing this phenomenon that is the Austin and really the entire Texas housing market. So Manisha, do you want to introduce yourself, and then I'll switch over to the presentation.
Hello, everyone. Hi, my name is Manisha. And as Annabelle said, that we are just very passionate about educating and all things finance related to women. And we really are appreciative of this group that Sarah started, because we just know how many women are out there who can benefit from this discussion and discussions like these. And not just, on your day-to-day life, but thinking about your future when you're thinking about retirement, or when you are going into that phase where you are all by yourself, and whether you're divorced or whether you are widowed or anything. And when you're dealing with all these issues, I think this would be a big thing if you already know how to do financial planning and how to do take care of your finances. I think that is a big help, because dealing with a divorce or death of a loved one is itself a hard time in your life, and you don't want to deal with all this. So we love this group and the discussion. So yeah, we are looking forward to a very meaningful discussion today. We'll both tag team on the slides, but yes, feel free to ask the questions, send in those questions. And Annabelle, I'm going to hand it over to you to start the presentation.
Great. Okay. We're going to see if I can get this to work correctly. It's always.
I just wanted to point out to everybody who entered a question, you guys added it to your presentation. So don't feel you have to add it to the chat group again.
Let me just see if I can get this set up correctly here. Okay. Can everyone see that?
Yes.
Okay. I can't see faces, so voices are great. now that I'm sharing.
It looks good. It looks good.
Perfect. Okay. So we're going to kick this off with, as Sarah mentioned, a quick disclaimer that the presentation here references opinions, and it's for informational educational purposes only. It's not intended to constitute legal, tax, accounting, or investment advice. And as Sarah mentioned, you should seek a duly licensed professional for individual advice based on your own situation, your goals, your needs, and your risk tolerance. So our compliance advisor always likes us to start with that. So today, go to the next one, for our discussion, we're going to start with an overall look at the Austin housing market conditions and historical data. This is, I'm a public policy professional in my previous life, and so talking about data and patterns and the macro level context, I feel is very helpful before you get into the more granular issues around home equity. Then second, we're going to talk about some definitions and terms that you hear thrown about a lot related to home equity. Sometimes these can get confusing and they're used interchangeably. So we'll want to go through those and just sort of from our perspective share what we as financial professionals and what kind of industry parlance is when it comes to the term home equity and the associated tools and different programs around home equity. And then third, we're going to jump into the fun stuff, which is what we've kind of gathered together a framework of really the sort of top 5 options that we find to be most common when we are working with clients and just analysis that you see, in the media from all different perspectives. But that would be selling your current home and moving, staying here and improving it, buying a rental with your equity, renting your current home and moving someplace else, and finally not doing anything. So we're going to talk through each of those individually and the, kind of have some facts and figures around that, but also some general education. And then we will close with a general group discussion because we love to hear more of your questions. Thanks to everyone who submitted questions in advance. It was amazing just to kind of see the level of interest in this topic. And many of the questions were very similar and hit on very similar themes. And so hopefully this presentation will cover the majority of those. So we'll get in to our next slide here. So this is a data source that I really like and Manisha really likes. It's called the FRED data. It stands for the Federal Reserve Economic Data, and it's maintained and hosted by the Federal Reserve Bank of St. Louis. And it's a massive and amazingly useful database with all sorts of United States macro and regional economic and financial data. And it aggregates it from a variety of sources, many of which are government agencies. So it's very credible and reliable. So we're going to start with this chart, which shows data going all the way back to 1965 here. And as you can see, around that time, the median housing price was right about $25,000. Then fast forward through on to the recovery in the United States after the Great Recession, the financial crisis in 2007, 2008, as things stumbled a little bit, then picked up steam, kept going, and then hitting into the kind of post-COVID recovery, you see this sharp, steep climb, really just within the past 18 to 20 months. So housing prices have steadily gone up. You can see just sort of this, it's a much more compressed period of time where these price hikes have occurred year over year. And now the median home we'll go back to 2010 here, looking at 2010, the median home price was around $222,000. That same home now is hitting around $374,000. So again, this is for the U.S. overall, not just Austin, but it does go to show just this, very, very dramatic exponential increase in the median sales price of homes. So exciting time to be a homeowner. Also a hard time to be a buyer or a mover in some cases. Let's go back here. So looking at Austin area homes specifically, and this is one of the great things about FRED, it can give you very specific regional data, and you can look at specific markets. So this is Austin, Round Rock, Georgetown. And we also looked at some of the data around South Austin, and it's very similar. This is the price index that you can see starting, before mid 1970s, and then ticking up and up and up, and really within the past 5 to 10 years, this dramatic increase is happening here. So you aren't imagining it. The data shows it. It's very clear that those prices are going up. And what the data also tells us, we pulled up a couple more stats on this, that the population in Austin has grown about 20% in the last 10 years. And on average, the data from the government and the Census Bureau is showing that the growth is averaging about 2.5% year over year. And again, I know that those of us who drive and work and stand in line for restaurants are feeling that population growth in Austin too. In the past 5 years, the home prices in Austin, this is a pretty astounding statistic, have increased by over 58%. So 58% in the past 5 years. Oops. Clicking on two different screens here. This is specifically, again, looking at a much more narrow view, really going back prior to 2019. Here is kind of where this starts. This is from the Federal Housing Finance Agency. So they're looking at mortgages and mortgage data and lender data to come up with all these numbers. But just within the past year, home prices have increased by 29.8%. So that relates to this spike that you're seeing here. And active listings of homes, which is very interesting, conversely, have decreased more than 70% in the past year. That might be changing as things are cooling off from a white hot market to more of a sizzling market this month and the next month. But the inventory and availability of homes is decreasing rapidly at the same time that the prices are increasing. So that's where you see a lot of these factors at play. And things, it's hard to tell, what could happen. There's a possibility that things slow down and cool off a little bit, but they could also get even crazier. For example, Tesla announced their new headquarters last week. They're going to be moving to Austin. Number of other national employers and global employers are looking at Austin and have made recent moves here. So it could, it's hard to tell what's going to happen. It could go either way. And just a couple points that we hope on neighborhoods, which is that in Austin proper, Tarrytown is the most expensive neighborhood with an average selling price of $1.5 million. The most affordable is Montopolis with an average home price of $349,000. Manisha, I'll turn it over to you.
All right. Thanks, Annabelle. Can you guys hear me?
Mm-hmm.
All right. Okay, so let's start with the very basic of what is equity. So we've heard a lot of this term floating around nowadays. Oh, I have $1 million equity in my house. I have $500,000 equity in my house. So when people say that, what do they actually mean by that? So this is just a very simple example of this. Is say your house is valued currently at $400,000. And your current mortgage is 70% of your house value, or $280,000. So the equity in that house that you own right now is 30% equity, which is a simple math. 30% of 400,000, it's going to be 120,000. Now, is that constant? No, it's not going to be constant. It will depend on a lot of other factors. Usually, the way mortgage works is when you start your mortgage and you start paying down your mortgage, you're paying interest first and you're not paying the principal. So you'll think that, oh, I paid my $3,000 of mortgage this month and I'm building $3,000 of equity. And no, that's not the case, because what is happening is that for the first few years of your mortgage, you're actually paying more towards the interest than you're paying towards your principal. As time passes, and as, if you are in that 15-year loan or you're in that 30-year loan, as time passes, you start paying down more of that principal. And that's when you start building equity. So that's your hard equity. That's like, okay, the price of this home stays constant. There is, you're paying down your mortgage and you're building equity in the house. But what's happening in Austin market right now is just not that. there then comes the demand and supply of, of the market, what Zillow shows, because, for example, my house last year it would show 500,000, but if now it's showing 700,000, I didn't do anything. I didn't pay that 200,000 of mortgage, but I just build that 200,000 of extra equity because, just of the market demand, and that's it. And that's what is happening. And as Annabelle mentioned, that we don't know, we don't have a crystal ball if that's going to keep happening, and that might not happen. So just think of it at like, if you have hard equity in your house, that's going to be always there. But the equity that changes or that fluctuate with market fluctuations, that's what you have to be really cautious about. And we're going to go over that in the further slides, but yeah, that's what we're talking about right now. So Annabelle, if you can go to the next slide, please.
Oops, sorry.
All right. So this is just an example of what I was talking about. So if you bought a house in 2011 and for 400,000, you did 20% down payment, 120,000, and the mortgage the mortgage on that house was 280,000. Your home equity at that time was 120,000. Now this is what has happened today in the Austin market. The thing that you see on the right-hand side, your estimated value of the same house is 800,000, and your mortgage balance, because you have paid down in 10 years, is 180,000. Today, your home equity is 720,000. And that's the big question that most people today here are looking to get answered, that, okay, I have 720,000 of equity in this house. What should I do? Should I buy a rental property using this equity? Should I sell my house and get all this money and use it for my retirement? Or, should I remodel my house or upgrade the house, or some questions like that? So these are the big questions that we're trying to answer today. Again, it's going to be, the presentation today is not going to go into your personal situation. It's a very high level view of the things that you can do with your home equity. But yes, so we're going to be discussing that. Sarah, at this time, if anybody has any questions, we can take some questions.
Quinn and Lori, as you've been looking at it, do you have a couple questions that you want to pull together?
I think some of the questions that people have are, what are we doing with it once we figure out that we have equity?
Yeah,
one question that you guys might address later is, are there benefits to using the equity as opposed to doing something else?
Okay. Yeah. So, I think, as we go through our presentation, most of those questions, that's what we're trying to answer today. But I just wanted to give a chance to see if people had any questions on so far what we presented. But if there are none, then we can just, keep going.
Yeah, it definitely looks, Manisha, like the questions. Okay. If we kind of start out with like how, like this slide, right? Like how to get the equity, and then it might morph into like strategies for how to use the equity. Yeah. So I think that's how you guys have it set up.
Can I have a question. This is Mina Thomas. I have a question on the example you gave. You said there was a home equity of 720,000. Is that 800,000 minus 180,000? Shouldn't it be 620,000?
You are right. You're right, Mina. Thank you for catching that. That is a mistake on our part.
Okay, no problem.
A plus, yes.
I would have liked more equity, but just.
Thank you. All right, so let's go into some of the ways that, these are the terms that you might have heard recently. How do you access that home equity? So the number one, thing is cash out refinance. What is a cash out refinance? So you have a mortgage in your house currently. You go to the lender and say that I want to refinance, but I also want some cash out of my house. So that's exactly what a cash out refinance is. So 800,000 house, you have a mortgage of 120,000, 680,000 is your equity. So you can refinance the house and you can get 100,000. If you want 100,000 money cash to do anything that you want to do, you can do that. It does not create a second mortgage on your house. It will become the first mortgage of your house. And, right now with the current mortgage rates, as we all know that the mortgage rates have gone down, it might be advisable to do that. If you have been holding on to do some of those big home projects that you were not able to do, but you can get this cash right now to do that, this might be the time to do that. Again, as we are refinancing, this could again be a 30-year loan or a 15-year loan. The interest rate that you get will depend on the term of the loan and everything. But one thing that you have to remember, that you must pull out that entire balance at the same time. You cannot say that, oh, I don't need 100,000. You work with the lender, and if it come up with a number of 100,000, you'll have to take that 100,000. So you want to make sure that you have a good idea of what you're going to do with that 100,000, because you're going to pay the interest on that. Whatever you refinance at, you're going to pay the interest on that, and then you want to have a good use of that money. You don't want to put it into your savings account that is not earning anything, or just not do anything with it. Like I to give you an example, we were talking to a client, and he did cash out refinance to upgrade the house and get a swimming pool done, but then ultimately did not end up doing anything. And it's like he's doing a negative return on that money, because with the inflation and everything going on, and he's paying the interest rate but not doing anything. So we want to make sure that when you're doing a cash out refinance, you know what you're going to do with that money, because you're going to get that money all at once. Now, let's talk about the HELOC. HELOC is what stands for Home Equity Line of Credit. So this is something, it's a second mortgage. It's not going to be, so you do nothing with your current mortgage. What you do is you go to the bank or the lender and say you want to open a home equity line of credit. Usually the closing costs in this one are very low, not much closing costs, but this is going to be a second loan on the house. You're doing nothing with your first mortgage remains the same. And this one is going to be like, you open a home equity line of credit for say 100,000, but you don't have to pull the money out at the same, right at that moment. It's there for you to use it when you need it. So, this is a perfect example of a situation where you can take advantage of this right now, because you have all this equity in the house. You have this 100,000 available to you that you can use when you want to use it, but you're not paying interest until you start using it. The only thing with this is that usually this is a variable rate. This is not going to be a fixed rate. So the one thing that you have to be really cautious of in this one is the rising interest rates. So as the interest rates start going up, you want to make sure that you have enough cash in the bank or something that if you need to pay this off quickly, you can do that. So that's something to be mindful of when you're doing a home equity line of credit. You can use it for another thing is that with the Tax Cut and Jobs Act that was passed, only the home equity line of credit cannot be separately taken as a tax deduction. The total combined balance is $750,000 that you can take a tax deduction for the interest that you're paying. So it does not matter if it's a home equity line or a FUS. Also, the home equity line, you can only take a deduction if you use it for home improvements. If you were to use home equity line for something other than home improvements, you won't be able to take a deduction on your taxes for this one. The third is a home equity loan. And this is confusing because we as financial professionals have seen a lot of even lenders using these two interchangeably. And that's very confusing. But remember, these are not the same things. Home equity loan is kind of a mix of cash out and a HELOC. So home equity loan is a second mortgage, just like a HELOC, but you have to take the whole lump sum out. So again, talking about that 100,000, it's going to be a second mortgage on the house. And because it's a second mortgage, the interest rate is going to be higher it's usually higher than your first mortgage or, even a home equity line of credit. And it typically comes with a fixed rate, but you must pull the entire amount out at closing. And again, this is, going back to the cash out refinance. You want to, when you're pulling this money out, you want to have a good use of the money. You just don't want to pull that 100,000 out and pay interest on it and not be doing anything with this money. So next, we can go to the next slide, Annabelle.
Oh, actually, we do have a question.
Sure.
If you do a cash out and you die a year later, does your cost basis for your heirs, does it go from the date of the refinance, not the original loan?
The cost basis for the heirs, and that's a good tax question. So I'm going to refrain from answering that question because again, I'm not a tax planner, but that is a really good question. The cost basis from Sarah, do you have any insight on that? Because what I am thinking is that the cost basis will remain the same that you bought the house, because the cost basis will only come in play when you're selling the house to take advantage of the capital gain. The cost basis is not going to come in play on whether you want to repay that mortgage or not.
Right. So the cost basis is the value of the house. When you die, the value of the house, the cost basis gets a step up. They call it a step up in cost basis to the fair market value as of your date of death. So that affects the value of the house and the starting purchase price that your heirs would get versus the selling price if they turned around and sold it. The mortgage value doesn't play into that. So if you bought a house for $100,000 and when you died, it was worth $500,000, your heirs would get a step up in cost basis to $500,000, erasing that gain from 100,000 to 500,000. But the mortgage that's left on the house wouldn't really be affected by that specific step up in cost basis. The amount that they would walk away with is probably more, but the cost basis is on the value of the house, not the mortgage. Does that make sense? Did I explain that right? Yeah.
Sarah,
Diane, did that answer your question?
She said yes. And I
Awesome.
think Mina had a question.
yeah, so this is probably a dumb question, but the reason the cost basis is important in this example that you gave is that the heirs would have to pay a tax on $500,000 worth of a house, or what is it? Why is it important?
Yeah, it's a great question. It's because when you go to sell an asset, generally speaking, when you sell an asset, you pay capital gains tax on the difference between what you bought it for and what you sell it for. When you inherit an asset, your cost basis goes all the way up to what the value was on the date of death of the person you inherit it from. So in my example, if you bought a house for $100,000 and it was worth $500,000 and you gifted that house to your kids, let's say, they would also get the cost basis of $100,000. If you die and they inherit the house, that starting value goes from $100,000 to $500,000. So then they only owe capital gains tax on the difference between $500,000 and whatever they sell it for. So you've basically erased a capital gains tax for your heirs by having them inherit an asset instead of gifting them an asset while you're still alive.
Right. Thank you.
Oh, we actually do have another question. You might, I don't know if you're going to talk about it later.
Yeah.
Caitlin, do you want to say your question, or do you want me to read it?
I can read it. Yeah. So a HELOC, or because it's variable rate, does that change over the life of that loan, or just is the moment that you take it out, that's how the rate is determined.
So it can, no, so you'll take out the loan at some rate, and your lender might say that it's fixed for some time, and then it's going to become variable. And it's going to be like, it can be fixed for 1 year, and it could be variable after 1 year, and then that rate can keep on going up, or it could go down. In a rising interest rate environment, that rate will go up, but in a decreasing interest rate environment, that rate will go down. So it will depend on the terms of the loan when you take out that HELOC. So it's very important to read those documents at that time. But most of the time, a HELOC is variable for the long term.
Okay, thanks.
Do you guys have any insight about taking loans out on just land, a HELOC or an equity loan on land?
Usually, from what our experience shows, is that unimproved land there are not a lot of lenders that might give a loan on an unimproved land. But for example, if you bought an unimproved piece of land, but you have done some improvements to that lot, or the water has been added, the utilities have been added, and you have done some other kind of improvement, there are some lenders there are some build loans or some other kind of loans that are available. They're not as easy. Not all the commercial banks would do that, and there are special lenders for that, but they are available if there has been an improvement done on the land.
Yeah, that's usually called a land equity loan, just for reference.
Oh, yeah. Katja called it that. I just skipped that part. So talking about variable loans, if you were going to get something that had a variable interest rate, how would you determine if now is a good time to do that or not? Do you, usually the Fed, they say, oh, the Fed signaled that interest rates are going to stay the same, or the Fed signaled they're going to raise the interest rates. Is that what you look for in the news?
And this going back to the thing that there is a lot of noise in the media right now, and what the media says and what's actually happening might not go hand in hand very often. Like, the media anticipates a lot of stuff that the Fed might do, but that might actually not happen. So it's a lot of noise that happens. But when the Fed determines, yes, some rates, and then once the Fed has made that decision final, if they're going to increase the rates, if they're not going to increase the rates, based on that variable rate will increase. And sometimes it also depends on the demand and supply and demand from an institution. So that is also another factor that plays a role in what the rate you're going to get from the institution. So it's just not one factor that controls everything. But again, we don't have a crystal ball. We don't know what the Fed is going to do. They say they are thinking of tapering, and they might, but they're also looking at inflation right now, because they don't want to cause a situation where they increase the interest rates, but then the job market is not improving, and all these things are not improving. There is not still economic recovery. So it is not just one single factor. It will depend on the housing market. It will depend on the job market. It will depend on the economic recovery. It will depend on the supply and demand of not just the houses or loans. It will depend on the supply and demand of a lot of other things that are being affected. So it's just not one factor. And what the Fed is going to do, honestly, I wouldn't just believe the media for that. So we're going to say that if it makes sense for you and you have a good use of that home equity line of credit and you want to do it, do it. But if you're just opening it because you just, and again, that's the good part about home equity line of credit is that you can get it and not use it. But if the rates go up, there is no guarantee that your home equity line of credit interest rate will not go up.
Okay, great. Thanks.
All right, moving on to the next slide of home equity and how to utilize it. Option one, which we are hearing a lot of Austin homeowners say, is we're going to sell our house. Yeah, great option. It's a seller's market. You can sell it. What will it depend on? Well, it depends. The number one thing that selling is going to do is change your quality of life or change what you're doing right now. So selling is a good option, but it'll depend on the stage of life. For a couple with young kids, do you want to disrupt their life? Do you want to disrupt where they're going to school? Does it make sense? If you're still looking to buy in a good school area, what will you be able to afford in that next area that you're looking to move on to? And you'll have to evaluate your cash flow in that situation. So it's, one answer is not like selling is not an answer for everybody. You have to evaluate where you are in that stage of life. If you have kids that have moved out and you're in an area where you're paying high property taxes, and you want to move out of that area because you want lower property taxes and stuff, it might make sense for you because you probably can move out to the suburbs where there are not many good schools right now. So it might make sense for you in that case if you want to lower some of your costs. For pre-retirees, this is I would like to give an example on this one. We had a client recently who was planning to retire in 2022, but given he was in Tarrytown, the house prices have gone up like 50% in the past 1 year, and he decided to retire early and take advantage of this because he's moving to a very low cost state where the housing, like, probably he'll be able to buy the same amount of house in $200,000, and he's almost going to take like $1 million out from the house and use it for his retirement income. So if you are in that stage of life, probably it makes sense for you. But but you have to have, you want to be ready to invest that money to get you a good stream of income for your retirement. So yes, but again, any of these factors will depend on, it is more than a quantitative decision, it is also a qualitative decision, because your house is just not like an asset. It's where you have brought your kids, where you have spent so many years of your life. So if it all makes sense to you, yes, for sure, go ahead and take advantage of that equity, but evaluate it with your family. Some of the things some people might consider is, do you want to downsize? Yeah, if you are ready to downsize, yeah, totally, go ahead and sell that house and take advantage of the home equity. Are you ready for an alternate lifestyle? Again, changing your house, moving to a new city, meaning that you are changing your friends. And sometimes it's just hard to make new friends in a new neighborhood. So are you ready for that alternate lifestyle? And the last point I want to touch on is the market timing. Some people, and some clients that we have heard is like, oh no, I'm going to wait for the market to go up even more. Or I'm going to, but again, as with stock market, we cannot time the markets. If the situation is right for you at this moment, there's nothing like the present. So go ahead and take advantage of that. And, you can sell your house, move to a smaller neighborhood or out of Texas, out of Austin, and definitely take advantage of that. All right. Thanks, Annabelle. The option 2 is remodeling or home improvements. So, again, this is a great time to do that. probably you have been thinking about that kitchen remodel for so many years, but given that we all have like young kids, some of us have young kids, and with daycare costs and kids activity costs, we're not able to save that lump sum amount of money to remodel or do any home improvements. This might be the time when you have so much equity in the house. Currently, the rates are low. You probably can get any of the loans, whether it's a HELOC or a home equity loan, or even a cash out refinance. The rates are currently low, and you can get it between 3 to 4%. Usually, improving your house will add value to the house. Now, it depends on what you're improving. So, when we were doing the research, we found out that adding square footage to your house or additional room adds the most value to your house. So, if you're spending $200,000, or I would say $200 per square foot to add a room to your house, depending on the area that you are in, it might actually add $300 per square foot of value to your house. That's instant equity that you build up just by adding a room to your house. Some of the things that add value to your house is a mid-range bathroom remodel or a mid-range kitchen remodel. Bathroom and kitchen are two of those things that you can spend as much money as you want. There is no end to it. So, but a word of caution there would be to just do a mid-range, because if you spend too much money on it, you might not get the return back from your investment there. Window replacement. That's another thing that adds actually a lot of value to your house, because if you have those old single pane windows and you replace them with double pane energy efficient windows, you can add instant value to your house. And going back to the question of the cost basis, every time you do a remodel to the house, it actually adds to your cost basis. So if you bought the house for $200,000 and you did $50,000 worth of window replacement, your cost basis would be $250,000. So that's just something I want to mention there. Then, if you want to add a deck or a sunroom, it adds some kind of value to the house. One other thing that was surprising to us, siding replacement. Siding replacement actually adds some value to your house too. So if you have that old siding and you want to get this replaced, not that expensive, but it does add value to the house. Right, moving on to the next slide. Here's what we just found a really good visual for it. So again, your return on investment for your renovations, turning the attic into a bedroom, you'll get 83% return on investment. Window replacement, 77%, or siding replacement is going to be 80%, and so on and so forth. But yeah, if you're customizing your house too much, you might end up spending a lot of money, but might not get the return on it. So just be cautious of what you are changing and what you are renovating. Right, we can go to the next slide, Annabelle. All right, some of the challenges in current market for home improvement: rising construction costs. And this is something that I have personally experienced. The historical cost for, 10 years ago, when we tried to do something to our house, the cost for construction was $100 to $125 per square feet. The current cost, $225 to $250 per square feet. And that data is 2 months old. With all the supply chain issues that we are facing currently, I think that cost might have even gone up in the recent months. Because the costs have gone up, there are less returns less return on investment. Supply shortage. There is a lot of supply shortage. If you're trying to get a pool done, you will not find pool equipment. If you're trying to get, there's just supply shortage everywhere, labor shortage. And all these things will add to the time you need to finish your project, because you might plan to finish your project in 3 months, but that might not happen. And so these are the challenges that, especially in Austin market, we are facing, because there's so much construction going on right now that it's just hard to find for you. So that just keep in mind the challenges when you're doing home improvement. Right? I think we have time for some questions. Gwen.
Okay, there was one question from someone who joined with their iPhone. The question goes, I have a HELOC that I used for a kitchen remodel and replacement windows. I still have 50% equity, even with the HELOC balance. In that instance, would it make sense to refinance to pay off the HELOC? I may have to move out of the city and rent my house, but I plan to continue owning it.
All right. So renting is another thing that we're going to cover in the future slides. So I think we're going to hold off that question until we go to the next slide, because if you want to change your house to a rental property, or if you're thinking of buying a rental property, there's a lot of other issues that come in play. So we'd like to take that maybe later.
Okay, that's perfect. And then for the person that submitted that question, if you still have the same question or a follow-up question after we've gone through that slide, just go ahead and put it in the chat.
Okay. All right. So should we just move along?
Yes, Chrissy, I'll save your question for after the next section. Okay.
All right. Okay, let's go to option 3, buying a rental property. This is one of the hottest topic of discussion right now. We have almost all our clients that we are currently getting, or that we are bringing in. Their first question is, I want to buy a rental property. What should I do? So, this is a really great time, but there are some things like it's attractive because of appreciation right now. So if you do a cash out refinance from your primary residence, and again, just keeping, for the sake of simplicity, I'll just keep it at 100,000. If you want to take out 100,000 cash from your property, yes, you can take that out, use it for down payment of that rental property. It definitely works well in a rising real estate market. But, you have to think of it that how much equity you have in the house and how much you're taking out. Because if you don't have that much equity in the house right now, and you take all of that out and the housing market crashes, you're underwater. So that's what you want to be cautious about, is that how much of that home equity you want to utilize to buy a rental property. Because if the housing market crash, your rental property prices are also going to crash. Also, you might not be able to rent that house. So when you're thinking about buying a rental property, you're technically become an investor. And as with everything, as we talk in the financial world, that there is no free lunch, or everything has risk and rewards in it. So everything comes, if there is a reward, it has some risks in it. So that's what you have to be cautious about. Again, the cash out refinance that you're going to do, it might be at a little higher rate than what you would just refinance your house if you're not doing any cash out. So it will impact your cash flow as well. Then another thing to keep in mind is that you've taken that 100,000 out from your primary residence to buy the rental property, and that's just the down payment of the house. You buy a rental property for 500,000, or even, I don't know if you can find anything for below 500,000 in Austin market right now, or 400,000. You still have to get a mortgage for the rest 300,000 if you find a property for 400,000. And the rental property interest rates are much higher than what you would get on your primary residence. So that's another thing that, you want to be careful about. And as I mentioned, that you have to be cautious of another situation similar to 2008, where the housing prices went down by 30%, or even more in some areas. So that's something that you have to be careful about. I have an example on the next slide on how you should evaluate your rental property cash flow. So if, that's what we're going to look at. it's a very simple example, and it just pertains to Austin market so much that I thought it would be useful. So if you want to buy a house for $400,000, and then you're going to use that $100,000 cash from your cash out refi to make the down payment, the rental property mortgage is $300,000. Your interest on the rental property mortgage is suppose 3.5%, and you're able to get a rental income of $24,000 based on the 3.5% interest. Your mortgage payments is going to be $16,200. You're still going to be responsible for when you buy a rental property. You're still responsible for buying the property tax and for paying the property tax and insurance. So, given the Austin market currently $7,000 on a $400,000 house is what probably the current estimate is. And there will be other costs of maintenance. You will account for, typically we want to account for vacancy, maybe 2 weeks in a year it might be vacant, or you're responsible for all the repairs in that situation. So, given that $6,100 per year is going to be your other costs. So if we go to the next slide, we've just, you will be cash flow negative for on this investment. For a year, you'll have $5,300 of negative cash flow. What that means is that you'll be subsidizing all that cash that you're getting from your rental property from your own cash flow. Now, in rental property world or in real estate world, there's something called the capitalization rate. So the capitalization rate is the return that you get on your rental property. And the way the capitalization rate works is the net operating income. So it does not take into account the mortgage or the mortgage payments. So without the mortgage payments on that $400,000 house, you're generating after all the expenses and the property tax and insurance and everything, your net operating income from that house is $10,900. And the capitalization rate is net operating income divided by the value of that house, which is 2.7% in this case. So that is what the return you're getting on that $400,000 of house. But as we were talking about in the Austin market, which is appreciating, that's what we are thinking that, okay, yeah, that's fine. I'm getting a return of 2.7%, but it might appreciate 6%. It might appreciate 10%. So just taking into account like an average appreciation rate, if the appreciation is 6%, your paid off expected return on that property is 8.7%. But if you're using leverage, basically if you're taking that $300,000 loan at 3.5%, your leverage rate of return is 12.6%, which both of these are pretty good. But remember that all this return rate is coming from 6% appreciation rate from the Austin market. So that's the thing, that's the risk you are taking in a rental property, is that do we know for sure? And if you're a risk taker, if you fall into that risk tolerance category and you're fine taking that risk, yes, go ahead, because this return could be more in the near future. So you have to evaluate any rental situation. There's two things you have to think: cash flow and your rate of return. Annabelle, we can go to the next slide. Thank you. So these are some of the key things that you have to take into consideration when it comes to rental property. Approach it from a total portfolio perspective. So what part of your portfolio or what part of your assets would you want to be invested in rental property or the commercial property or any kind of property? That depends on that. The way we think of rental property is it's part of the stock portfolio. Because if you think of a stock portfolio, the returns are coming from dividends, plus the growth on the stocks, plus the inflation. Similarly, the rental property is pretty much the same. The returns are coming in the form of your cash flow, plus the growth, plus the inflation. So you have to think that rental property is part of your stock portfolio, and how much, when you do your risk tolerance, or how much risk do you want to take with your money, and how much do you want to put in stocks. So what portion of your stock portfolio would you want concentrated in one company? It's pretty much a situation like that, because if you've invested 400,000 in a rental property, then think of it that you're buying one company with 400,000, and are you ready to take that risk? So that's you have to evaluate it from that perspective. Again, leveraging your rental investment will always give you better returns, because you are just taking like loan and paying at 3.5%, but you're gaining from all the appreciation that is happening on the entire property. So that's why when you're buying a rental property, you should always try to think about leveraging your returns. You're taking use of the leverage. Then, as we saw in our example, you'll have negative cash flow. So does your budget allow room for negative cash flow from rental property? That's a big consideration, because we don't want to be in a situation where we are having negative cash flow year over year and we are chewing up our savings or emergency reserves, because you might, so keep that in mind, that you should always have your cash target or emergency reserves, and that is not chewing into that, or you're not subsidizing by taking out payments from the 529s or education accounts or your retirement accounts. So those are the things to keep in mind when you're buying a rental property. And then again, risk return trade-off. Buying in a highly appreciated market like Austin, you're betting what I would say is that you're taking that risk that the Austin market will grow, but what if it will not grow? You already have negative cash flows, but Austin market might not grow 6%. And then there's also some other markets where you might get a positive cash flow, but you will not have that much appreciation in the market. So that's something that you'll have to decide for yourself. So these are some of the things that should keep in mind when you're thinking about buying a rental property. I think we can take some questions, Sarah, now.
Okay. Oh, sorry. Go ahead, Gwen. Why don't you go ahead and do it?
Sure. So Katya has asked a question about timing. How soon from getting a cash out refi can you buy a rental property? And then in addition, what if you decide to cash out refinance and then want to move and rent your current home and then buy a primary? Do you have to wait a certain amount of time?
So no, I don't think you'll have to wait any amount of time. But when you're going to apply for that second loan, the rate of the loan is going to be dependent. What the lenders look at is your total. There is something called the PITI in the finance word. That's I think it stands for principal, interest, taxes, and insurance. And what the lenders look for is the PITI on your primary mortgage plus your rental mortgage or any other property you are buying should be less than 25% of your gross income. So there is no waiting time. You can go ahead and do that, but that is what the lender is going to look at, and that is what is going to determine the rate of interest for your next house or your rental, or if you're even thinking of renting your current house and taking cash out refi and moving to another house, even in that case, that's what most of the time the lenders are going to look at. All right. Any other questions at this time? All right. Moving on. We already had somebody ask a question about this one, and so renting your house and living somewhere else. Yes, you can do that, but again, this is a combination of like selling your house and moving, or buying a rental house and renting it out. It's going to be, are you willing to relocate somewhere else? If yes, then yeah, go ahead and do that. can you know, one of the benefits of this, if you're trying to relocate to a not much appreciating area or one of the states or suburbs where the housing prices aren't that much, this might make sense that you can still take advantage of the appreciating Austin market without selling. But in that case, evaluate your cash flow situation. You'll still have to pay the taxes or the expenses, upkeep of the home you still own, wear and tear of renting. So you'll still have to, pay for all of that. So just evaluate all the situations, and cash flow will be better if you're moving to a suburban or a less in demand area. So yes, that option is available, but you'll just have to evaluate your cash flow situation. Again, keeping in mind that you're not chewing up your retirement and your retirement portfolio or your 401ks. You're not compromising on the college. If you're saving up for college for your family, you're not compromising on the emergency reserves that you currently want to hold. And you're not compromising on your cash situation. So that's something, if it's a negative cash flow situation, you'll have to deal with, carefully evaluate that. And I think I am going to turn it over to Annabelle now.
Yeah, I was just going to add a few more things to that, Manisha. So this situation, the renting your home here and going someplace else, it's a common one we discuss with clients because folks do want to kind of keep a toehold in Austin, but might want a different quality of life for a little while, or do want to kind of see what happens with their home value here and keep riding the wave and hold on to it until they feel like it might continue to grow and they might be able to leverage that for a later sale. It does not, the renting your home here and moving someplace else, especially if you're buying someplace else, does not work as well if you are moving to another popular area like Denver or a Washington, D.C. or Seattle. It tends to work a lot better if you are moving to a much lower cost, less busy, less appreciating area, as Manisha mentioned. And for Texas is kind of a unique situation if you're a homeowner here because our property taxes tend to be so high and they are increasing very quickly. So you have to be able to charge enough rent to cover not only your mortgage, but also the property taxes and the associated costs of renting. So we all know renters don't take the same amount of care in your home as you probably would. So that's sort of an emotional issue too, even though you might feel like, it's your home and you're a homeowner. In reality, you actually become sort of a real estate investor if you are renting your home out. And you got to keep in mind that your return, at least in the short term, is really, that cash flow, the appreciation you won't really realize for, it's kind of baked in. You're not really going to realize it until you eventually sell. And from our experience, most markets provide either good cash flow or good appreciation, but rarely both, and sometimes neither. So that's something to keep in mind as well. We definitely consider Austin an appreciation only investment because in most cases, you'll probably lose money on cash flow when you kind of add up all of the likely cost of both renting your home, your primary home out and moving someplace else, and then sometimes buying a rental property as an investment property. And if you're at the point in your life where you do have spare cash to cover that and to float those costs and expenses for a time or date certain further out in the future, and you really do want to see that appreciation and you feel comfortable that that's going to be your end goal, is to really that the appreciation is your end goal, not necessarily the monthly or annual maintenance cost in the short term. That's just something to keep in mind. So really the takeaway here is just, make sure you have a very kind of honest and transparent assessment of the likely cash flow in these situations, both, buying a rental property and then also renting your own home and essentially committing to becoming an investor in both of these situations. So let me go to the next slide. I'm hoping oh, good. My animation worked. I'm never quite sure if it's going to. This is, again, this is more of an emotional, qualitative decision, not necessarily a quantitative decision for many of us. This is a, very exciting, very vibrant, very dynamic time in Austin, for better or worse. And while you might have, many friends who are moving, relatives, family members who are moving, colleagues who are, buying or selling or upgrading or downsizing. It really depends on your individual situation. So if you feel like none of these situations are really the best for you, or that there's not a clear answer or an optimal outcome, it's perfectly okay to sit tight and just enjoy what you like about Austin right now. That is a very a well-informed and in some cases, just for peace of mind and for less stress, it's a very good option. So we wanted to make sure that folks, feel like if that's what their judgment is when they come to evaluate these, potential options that might be relevant to them, and you come down to like, it's not very clear, or, I'm happy here and kind of want to see what happens. That's perfectly okay to do. There's certainly worse cities to be hanging out in than Austin. So go to the next one here. Okay, we will pause for quick questions, and then we have a few more things, including some information on reverse mortgages.
Hopefully this is a good time to go back to the question from the member who called in on an iPhone. And so her follow-up question, she said, the question about paying off the HELOC was mine. So just to remind you, it sounds like has a HELOC on her house, first mortgage, HELOC, maybe moving, maybe thinking about renting out her home, maybe not. She said, the question about paying off the HELOC was mine. I hadn't intended to rent the property, but I was surprised by a potential work transfer. Regardless of renting it out or not, in what situation should I consider paying off a HELOC with a cash out refi?
Okay, so that is a really good question. And it is, yes, that's what, like, if you have the mortgage from a couple of years back and you have a HELOC, you can actually either you have option of like combining the two and doing a refinance, and that will all become your first mortgage. Or I don't see why would you do a cash out refi in this case, because if you're not trying to pull out extra money from the house, the cash out refi might not make sense, and just a simple refinancing and combining both the loans would be advisable in this situation. If you should be, depending on, again, when you got the house, when was your original mortgage, and what's the rate, you might be able to, lower down your mortgage rates in this case if you combine and you have equity in your house. Annabelle, do you have anything to add to that?
Yeah, I think that's potentially a complex comparison of the interest rates, right? And kind of the amortization schedule for all of those various potential paybacks. Mm-hmm. And so there's a huge range of what it could be. Either wouldn't make any sense or definitely makes sense and you would save money. I think it really depend on, there's something like, there's legally, as far as I know, there's no, there wouldn't be any reason you couldn't do it. And people use, my mother, for example, who's 76, uses her house like a bank. She's refinanced 36 different times. She gets HELOCs all the time and home equity loans all the time and moves stuff around and pays stuff back. and it's, it's all, it's not tangible to her. It's just kind of, she just uses it for whatever her goals are. And so there's, there is a lot of fungibility with these different loan and financing products. So I think that just the question would be kind of a more complex one in terms of what combination of the interest rates and the payback and the groupings of that, as you said, Manisha, makes sense.
Yeah, can I add something there too? So this is Sarah. Because I think this is a really, really good question, right? Like with your HELOC, you have a variable rate, which at this very second is really low, but it's variable. And one of the other, I can't recall, Manisha, from your slide, if you mentioned this already, that typically on a HELOC, your repayment is interest only.
Yes.
Right. So
yeah.
So your it's a really different cash flow situation. It's like if I'm only paying interest, Sarah Glakis, financial engineer, thinks like, that sounds pretty good. That doesn't sound like very much to pay, 4% or whatever it is on a however many $100,000 HELOC. Whereas if you start amortizing that loan with a fixed rate product, you're going to be paying interest and principal. So your payment is almost certainly going to go up, right? Some people like that, right? Like some people are like, hey, I want to be paying back this mortgage. I want the principal to go down over time. I would like to lock in a low rate on a fixed rate mortgage or a fixed rate product and be forced to pay it back by having a principal payment. Whereas some other people who are maybe a little farther out on the risk spectrum would be like, I'm not paying back any of this principal. I will only pay as much as I have to for as long as possible. And I don't care about paying down the debt. I'm going to use that money for something else. So I think like, Annabelle and Manisha are totally right. It's a really complicated discussion. But for me, that difference between variable rate and fixed rate is important depending on how skittish you are about short-term rates going up. And also the interest only versus amortization schedule is like the second factor, which can really impact your cash flow. And people have different views on that too. So it sounds like no one answered that question because it's too hard, but hopefully it gave you like food for thought on how to think about considering which product you have, keeping the HELOC. Sometimes in HELOC too, there's a section where the bank will give you the option to start amortizing without needing to do a refi. You can just call them and say, hey, according to the HELOC loan documents, I can call you, lock in a fixed rate and start amortizing over 10 years, 15 years, 20 years, whatever it says in the contract. So it's probably worth busting out your HELOC loan documents and seeing if that's an option too, because you could save the $6,000 on a refi and just do it for free if you're into the idea of repaying that principal balance over time. That was a lot. So sorry, I wanted to jump in there because I thought that was a
very helpful
question.
No, that was great. Yes. Thanks for jumping in, Sarah.
Okay, so we're almost to 4 p.m. So Manisha, I'm going to switch it back over to you because I know you've got a couple more slides to go through.
Yes. All right. Going back to some non-traditional approaches to utilizing home equity, and this is something that we have seen in our practice happen. So paying off and all of these situations, we can't stress enough for everybody to evaluate your cash flow situation, because anytime you're making any of these financial situations, your cash flows, month-to-month cash flow situation should never be negative. And that's the biggest risk when we have a negative cash flow situation. And so evaluate your cash flow situation very carefully when you're thinking about all this. Paying for college using home equity, you have huge amount of equity. You didn't think that you would want to fund your kids' education, but now they have gotten into this Ivy League school and you want to help them pay off for their college and you don't want to burden them with all the loan. Can you use home equity for that? Yes, because you can get a home equity line of credit, or if you're doing a cash out refinance at 3 to 4% right now, you can use that versus the parent plus loan that is around 5 to 6% right now, and it might go up. So again, this again would be like related to the time frame of the repayment, how much you're thinking. Would you want your kids to be part of that payment, or you do not want your kids to be part of that payment? So all that will take into play here. But yes, you can use that. That is one of the non-traditional approaches for using home equity. Then the second one, and actually we did get some questions on that one, it is the consolidating high interest rate credit card debt. So yes, you can do that. So if you have 15 to 20,000 or 30,000 of debt, credit card debt, and most of the time the credit card debt is around between 15 to 20%. And if you have enough home equity in the house, and you can, even if you want to get a HELOC, or you want to just refi your house for a larger amount and combine that, you can do that. Again, this does not address the underlying problem of overspending, because usually that's the situation where we have a high amount of credit card debt is, when we're not managing our budget or cash flow situation properly. So you can do that, but you'll have to address the underlying situation in that case. Otherwise, you'll be again in the same situation. Tapping into home equity for short-term financial emergency. If you have a HELOC open already and something happens, a financial emergency happens, then it definitely makes sense to tap into that home equity to take care of that short-term financial emergency. As long, again, very careful, tread very carefully in these situations, evaluate your cash flow situation, right? Going on to the next slide, reverse mortgage. And again, this is one thing I do want to mention, that we had some questions in the Q&A for reverse mortgage. Reverse mortgages are very complicated. It is, if I was to say it correctly, it would take even more than an hour or 2 hours of discussion we can just have on reverse mortgage by itself. So I'm not going to go into much details on reverse mortgage, but did want to address it since we had some questions on this. So it's the opposite of a regular mortgage. Your house is paid off and you need money. What do? If you're 62 or older, you can apply for reverse mortgage. What happens in that case, the lender pays you money. And there are several products, just like in a regular home equity or a regular loan. There are a huge amount of, I think 3 or 4 products that are available the way you do reverse mortgage. You can get a lump sum payment. You can get an annuity out that pays you some amount every month. So there are some different kind of products available. You have to be 62 or older, as I mentioned, to apply. And there are costs and fees associated with getting the reverse mortgage. So it's, again, just like a refi or anything that you do. There will be closing costs and fees associated with getting a reverse mortgage. Usually it's a variable interest rate. And what happens in reverse mortgage, that you are not required to pay back the loan, or so that interest that you're not paying currently is added back to your payments, is added back to your principal balance, and you will owe more over time. As the time passes, you will owe over time. You will owe more over time. And so if something happens to you, your husband or your kids might not get anything back from the house because you probably owe more, on the reverse mortgage. Then one thing to keep in mind is that even when you get a reverse mortgage, you are still responsible for paying the property tax, insurance, and all the maintenance and the other expenses of the house. So if you're thinking of reverse mortgage to fund your retirement, and you're 62 currently, it might not be the best idea to do that. You might evaluate the situation and go back to selling your house, moving to maybe a lower, area where there's low housing prices, getting all that cash out and investing it to get a retirement income. That might be a better option for you rather than, and again, with reverse mortgage, the thing is that you're 62 right now. You don't know how long. We have no crystal ball. Nobody can tell you how long you're going to live. So you can't rely on that reverse mortgage to provide you with an income stream if you live up to 95. So that's something that you'll have to think carefully. As you know, again, with any reverse mortgage, financial assessment is needed. Beware of the sales broker. This is what I cannot stress this enough. There's a lot of sales broker who will come and say that reverse mortgage will solve all problems. No, it will not do that. So you have to be very careful. One of the most reliable information on sites where you can find information on reverse mortgage is the Federal Trade Commission site. Here's the link, and you can actually go to the site. It does a really good job of explaining reverse mortgage. It will take you to a link where there are counselors for reverse mortgage that will be able to help you on answering any questions for reverse mortgage. So so I think that's all I would say for reverse mortgage in this presentation. Right. Annabelle, I'm going to hand it back to you.
Okay, just want to make sure I'm not muted here. We've talked a lot about, all kinds of interesting ways you can use your home equity and leverage that. But we do want to stress that there are some situations that's not appropriate for, just to kind of, provide the alternate view on that, and to explain a little bit about some of the risk that might come with some of these situations. So home equity is it's a powerful tool. It's one that, a lot of us in Austin are, maybe even for the first time, are really, able to enjoy and think about using strategically right now, given the current market conditions and those in the past 5 years. Using that, comes with, as Manisha has stated a few times, just really thinking carefully about, what the purpose is, what your goals are with it, what your the outcomes that you want to achieve. So you really want to think about, home equity as a tool to improve your financial situation. So Manisha talked about, paying off, high interest or credit card debt. If you have been, stretched for cash for a long time, and you've got kids or a spouse or partner to send to college or go to grad school, and that you can use your home equity, for that. That's that's a positive step forward. It's generally not a good idea to use it for things that are real short term, real incremental. So that would be paying for that really nice or fancy vacation, which we all want to take right now. Buying a car or a boat is not an appropriate financing tool for that. And again, using the money simply to help zero down money shortfalls or resolve these kind of gaps that you're seeing continually, or you're seeing a pattern of day-to-day or month-to-month negative cash flow in your household or living budget. That's there's a deeper underlying issue there that should be, analyzed more closely and thought through. So we just wanted to provide those caveats up front, because it is exciting and it's fun to think about all the different ways you can use it, but let your imagination wander with all these potential ways to leverage it. But there's a couple things that there are more appropriate tools and resources to use for things like that on this list. So in closing, some final thoughts, and then we're going to go back to questions from everyone. Once again, your financial situation and that of your families is unique to you, and that really does require, careful and prudent evaluation, and looking at a lot of different sources of information, talking to experts in the field, talking to realtors, to reliable mortgage brokers, to people who are kind of in the thick of this and doing it day to day. That can really help in many cases inform that. A tax professional is going to be very important sometimes to some of these questions, and maybe some of the situations that you are in right now is potentially have real complex or burdensome, maybe tax implications. So that's something to consider. And really, again, any situation where you are taking out, for example, a HELOC, or doing a refinance and increasing your monthly payment, or adding on a second mortgage, essentially due to a home equity loan. Just really think about your month-to-month cash flow and your year-over-year cash flow, and if that's going to impact that negatively, then you want to make sure that really makes sense for you, and that you have a way to resolve that eventually. And so, as Manisha and I both share this philosophy that in personal finance there are no right or wrong decisions, there are only trade-offs, and that's very true for this particular topic as well. So thank you all for your attention, and we can turn it over to questions. Unless, Manisha, you wanted to say anything else.
No, thank you for closing this. And yes, I just want to say that we cannot stress enough on your cash flow. So just be mindful of whatever you're doing, evaluate your cash flow appropriately. And we can take any questions that we have now.
Cool. Thank you so much. I wonder if maybe for the next part here, for the next 23 minutes, if you have a question, maybe you can unmute yourself, and we can do it that way. I think we probably have a small enough group that we can manage to do that. So if you have a question, either that we didn't hit in the chat box, or something that you just thought of, go ahead and unmute yourself, and we will take some live calls for the next 22 minutes. You just nominate yourself to start. So. Anyone want to jump in?
I have a question. So, will there reach a point where the Austin market, I mean, I know eventually it'll plateau, but will it reach a point where it's actually going to decline? Like the value of my house has gone up so much. And I know that's not going to last forever, yes, but will it eventually go
down? If we knew the answer to that, we would have Chairman Powell's, Jerome Powell's job. No, but seriously, I'm a lifelong Austinite. I went to Matthews Elementary School here in Central Austin. And I would say that just due to there's some real core factors, circumstances, call it what you will, and inputs into the Austin economy. That's the University of Texas, the capital of Texas, and all of the state agencies, and then the just kind of like job growth and support that always continues to I guess, to aggregate. And the Austin market over time, if you look at the past 60 years, sometimes has stabilized or has cooled off, but it has never dropped or declined the way that we saw with like a Phoenix or a Las Vegas, or even less dramatic examples. It is always a continually over time average. It sometimes the pace is slower and it's not as sustained, but it always continues to increase.
Yeah.
Okay, thank you for that.
Chrissy, I can just add to that is that 20 years ago, and even in 2008, when the Great Recession happened, people some people said that about the California market, but no, it bounced back and is still going up. And so I think, going back to Annabelle's point, it depends on a lot of factors, the job market, the college and everything. So we might not see the negative, going down for Austin for sure.
Okay, thank you.
Great question. Okay, who's next? Go ahead and unmute yourself and throw out the questions that are on your mind.
Okay, this is Nancy. So I have a question. Maybe this is more real estate oriented, but of course the housing market, just building the houses, is exploding. I live in Pflugerville near the lake, and that was all farmland. In 2 years, there's like a 2-year waiting period just to get a house. But also everywhere, it seems like everywhere I go, the apartment buildings, I mean, everywhere. And these are large apartment buildings. So I guess my question is for renting. So my thought is to buy another home. I have 2. My thought is to buy another home and rent it. But how will and I know there's 100 and some people still moving here every day to Austin, but with all these rentals, the apartment buildings, and again, huge, we're talking about thousands of people. How does that affect, or how do you think that might affect the ability for individuals who will rent a house or be able to buy a house in the near future?
This is again a very evolving situation, and this is a situation that we might keep on seeing this kind of situation happen in Austin for a long time. And the way the economic cycle works, like we think for us like 3, 4, or 5 years is a long time, but the economic cycles 3, 4, or 5 years is not a long time. And so this, like we might think that, okay, this situation is happening, it will keep on happening, and ultimately, yes, there might come a point where there is some sort of stabilization, but it might not happen for another next 10 years. Given the amount of people, amount of companies moving to Austin, again, if we keep seeing the same amount of job growth that we have seen in the past 2 or 3 years for the next 10 years, that situation might not come where there's a lot of rental vacancies or stuff like that. So a very different situation than what Austin is used to, but yeah. So no correct answer for that. I don't think anybody has an answer for that.
I can add something.
Yeah.
We bought a house 5 years ago in a neighborhood with the intention of that being a rental. So we looked for a house that was inexpensive and we could pay for it completely. And we did. And we bought it in an area that wasn't a great area. The schools aren't great. It's just not it's an old neighborhood. The houses are old, they need work. But it was a great rental because for our rent, it was rentable because for the area it was in, it was very commutable. So we knew we could rent it to a certain group of people, young people, whatever. And so we did. And then through all kinds of changes and things that have gone on, we ended up moving into this house. But that's neither here nor there. We moved in because we could no longer get the rent we needed to cover costs. Up in value so fast that our taxes went up and our insurance went up. And it is an old house. It does need work from time to time, but we could not get from this sort of rundown area the rent we needed, even though it was a good location. It was great when the house was cheap. But now that the house has doubled, we had to move in because we can't get the rent. So rather than have a negative income, we moved in, or a low income. It wouldn't have been negative because we paid it off, but it would have been low. So that's a tricky thing. We have another house in a neighborhood that wasn't a great neighborhood, but it's shot up because it's near downtown. So there, and you have a situation, but there we can get tremendous rent. And question of the woman before asking about money for it, if you're in the right area, but then you're also going to be paying higher taxes.
Yeah. And thank you so much, Julia, for adding that, because, if, again, going back to the situation, you looked at your cash flow and you did not want to be in that negative cash flow situation for your house. And that is something that is going to happen. You might have a great rental property right now, but if appreciation happens, property taxes go up, other things go up, you might not be able to get it. We had, just to share another situation, we had a client of a couple of rental properties, but they never, for the past 15 years, they were underinsured on all their rental properties. And they were thinking they were getting the positive cash flow, but one of their houses currently burned down. And because they were underinsured, they could not get money to rebuild that house, and like at today's price. So again, with rental situation or any housing situation, evaluate that every year. Evaluate that, when that yearly contract comes up for your renters. Evaluate your situation. Talk to your real estate broker and see what the situation is, and it would give you a better idea of everything. Thank you so much, Julia, for sharing.
You're welcome.
I had a question regarding equity.
Yes.
Equity based on what the tax assessment office assesses the equity in your house, or is it based on, let's say, if you're applying for a home equity, a visual, so they would do a drive-by?
So that's a great question. Thank you, Susan. Equity yes, it's a very qualitative thing. It is going to be based on your appraiser that comes to your house to look at your house, your tax. All of us never want our house values to go up with the tax assessor, right? We think that the tax assessor should always have the low values for our house. But when the appraiser comes to our house, we always want him or her to appraise the house for a higher value. So your equity, or how much equity you have in the house, when you're trying to take out that loan or refinance that mortgage or home equity line of credit, when the appraiser comes to your house and what value they appraise or what number they give to your house, that's what the bank goes by.
Okay, thank you.
And that's this is Annabelle. That's in addition to, your on paper, your hard equity, what you've already, put in and what you paid into the house. Then you've got this sort of like more qualitative aspect of the assessor. And even sometimes it can be even relevant to the bank as well, a particular lender. And if they happen to, a lot of lenders who are more familiar with the Austin market in Texas tend to just have a better sense of the, rural kind of that factor, that equity variable factor, and others who are not as familiar may not value it as much. So, but that's a great question.
Thank you.
And Susan, I have a little bit of color on that too. Hey, Susan. I just talked to a banker last week, and so your question hit on something he said that I thought was really interesting. He said that a lot of times the lender will go off of the tax assessment sight unseen. And so if you get a home equity line of credit based on your tax assessment, they'll do it they won't send an appraiser out, and you don't have to pay the appraisal costs. This lender then said, if you think that your tax appraisal is less than the market value, the borrower could pay for an appraisal, have someone come out, if you think that you're going to have a higher fair market value, which then theoretically would increase the amount you could borrow. Okay. So, but he said with this bank's case, he said you would pay for the appraisal if you think that the fair market value would be higher than what's on the tax appraisal. Okay. So it sounded like the bank would take the tax records at face value and lend off of that value, but they also give you the option to kick it up a notch. If you think if the tax appraisal says 500 and you think it's worth 650, you could pay for the appraisal to have them go out and see if it's actually worth 650. So I thought that was interesting. I'd never heard that before. No banker had ever offered me that option before. And I was like, oh, yeah, okay, it might be worth $500 to have an appraiser go out to get the real market value of the house.
Thank you. Well, I was just wondering, because I argued down my assessment, I have to basically replace my entire roof. So I had my assessment taken down because of damage, which I was trying to get hail damage, but long story short, they didn't find any hail damage. So in doing that, which would increase the value. So I had it decreased, and then I guess I would present that. One other question. Any suggestions on how to shop out the best home equity? As far as where to go to look, do you just compare straight up rates? Do you go to your local bank? Where would you go to search for that?
There's a lot of free, nowadays bankrate.com is like the easiest source where you can very easily find, like if you enter your address and everything, it'll give you it'll come up with some options for you to, get a home equity, and it'll give you a ballpark idea of what the rate should be. So that's something that you can start with. But yes, talking to a mortgage broker or, a lot of the regular commercial loans like Bank of America or Wells Fargo or for home equities, those actually are not bad options at all either, because they tend to be good on the home equity line of credit part of that. But yes, Sarah, do you have any insight on what would be the best option?
Yeah, I'll also throw Frost Bank into the mix as someone to call. Frost Bank, they're relatively local, and I think they're active in that space. Not every bank or credit union is going to offer competitive rates or competitive terms. I always used to recommend BBVA Compass, and they were just acquired by PNC Bank, and I don't know if PNC does the same type of lending that BBVA did, but Frost Bank is really active in that space too. So I would kind of put them on a short list to call them and see what they would offer. And I think it's like mostly driven by rates, but it's also driven by terms. So what does the payback look like? How long do you get to be interest only? What happens after you get through the interest only period? And this is like on HELOCs and home equity lines, or I'm sorry, HELOCs and home equity loans. So Frost Bank I would throw on there.
Okay, thank you.
There are also fintechs that are starting to get into the mortgage area. And I can't recommend them or speak even to what their fees and other, issues would be. But I do know there are fintechs now getting into this space. And they're getting in, from what they've told me, because they feel like they can cover clients who traditional banks won't cover. So obviously they think they have something to offer.
Yeah.
Julia, one other one.
I love that. Sorry, Annabelle, go ahead.
No, that one other one to throw into the mix is University Federal Credit Union, which is, local. And because they're a credit union, they're not for profit. And so they tend to have very competitive rates, both for mortgage, for conventional non-jumbo loan mortgage and refinancing. And HELOCs and home equity loans. They're generally a pretty good experience to work with. You do have to have some, you have to be a member there, but that's usually pretty easy. You either have to kind of have somebody in your family who went to UT, or you went to UT, or worked at UT. There's a couple different ways to become a member, but it's a credit union, and they have a big footprint.
Thank you.
And on Julia, on your point about the fintechs, I'm going to just throw this out there because this was my experience in 2020. I had gotten a line of credit. It was a business line of credit. So it wasn't a home equity line of credit, but a business line of credit extended by a fintech company. Fintechs are typically backed by, venture capital or private equity. Anyway, I had this line of credit lined up for my business. And in March of 2020, that fintech sent me and everybody else an email saying that the line of credit that we had in place would no longer be available. And so they just yanked it right out. So I had a very, very bad experience. It was a little bit traumatizing, which is why I'm sharing this here with all of you. That idea of like money coming into the, starting a fintech, making these products available to the masses, it's not the same as having a relationship with a banker. I was telling this story to my banker friend, and he was like, Sarah, you need to have a relationship with a proper banker because they will be there in March of 2020 and they won't yank your line of credit on no notice. So just sharing that with everyone, because obviously I'm deeply scarred and traumatized by this experience. And part of the Austin Women's Investing Group is sharing our trauma with people. So on that front, like, it can look good on paper, but especially with lending, you have to dig a little bit deeper and say, like, okay, you say you're going to give me $100,000. Like, is that still going to be there when the market crashes, or no? Can you just like yank it away? You know,
Or you
without,
buy a yacht and
any
sail
notice?
away and no one can find you.
Exactly. There's like, oh no, we're actually not going to lend you that money. Like, yeah, it was rough. So, but just traumatizing more than financially rough. It was. I still am just like appalled that it happened. So anyway, take it for what it's worth.
Yes.
Great. Awesome questions and awesome discussion. What other questions do people have? Well, okay. Well, we are skidding right into 4:30. Perfectly timed. I love when that happens. If there are no other questions, then I'm going to take this opportunity while everyone is still here to thank Annabelle and Manisha for putting together this awesome presentation on such a fun and exciting topic for us Austinites. Certainly reach out to Annabelle, Manisha, myself, Gwen, Lori, the Austin Women's Investing Group, if you have any follow-up questions. And as we mentioned before, we will send out the slides, and we'll post the recording to the YouTube channel. So unless there are any last minute questions, I'm going to say thank you to everyone for joining. Thank you, Manisha and Annabelle, Lori and Gwen, everybody, and enjoy the rest of your weekend, everybody.
All right. Thank you,
Cool.
everybody. Thank you, Sarah, Gwen, and Lori, for all the wonderful help you guys have provided us. And this has been great. And thank you all for the participation.